Before we get to Tyler Wood of the CMT Association, I want to talk about Schaeffer's Chart of the Week. It's an in-depth look at a stock, sector, index, indicator, you name it, that's captured the attention of our digital content team. For example, this past Sunday, we offered up a deep dive on 3 ETFs to watch amid the ongoing Russia and Ukraine geopolitical drama. Each Sunday, subscribers will get a deep dive into a compelling chart to explain why this is on our radar, what it means for traders, and how they can potentially profit from it. This exclusive report, available free to Schaeffer subscribers, is a can't-miss weekly dispatch heavily influenced by founder and CEO Bernie Schaeffer, a widely respected technical analyst who's one of the pioneers in the options industry. Hit the link in this episode's bio, enter your email address, and you'll have a notification of when Chart of the Week is active on schaeffersresearch.com. Now, let's get to Tyler Wood. Welcome back to Schaeffer Market Mashup, presented as always by Schaeffer's Investment Research. Patrick Martin here on 2/23/22. A very fun episode planned for you. The second I heard this guy's podcast, I knew he'd be a great guest here. Please welcome Tyler Wood, the Managing Director of Global Business Development at CMT Association. Tyler, it's great to finally meet you and your illustrious beard.
Thank you, Patrick. You got a good one growing yourself, my friend.
I'm working on it, yeah, and a little gray here too, actually. Which
markets have been tough, man. Gray hair is sprouting out everywhere.
I was on the golf course Monday for President's Day, and I sent a picture to my parents of because they're in Connecticut, snowy Connecticut, and I'm playing in Cincinnati. And my mom goes, "Is that a little snow I see on your beard?" And she threw off my entire day.
As only moms can do for us, right? We value their opinion higher than anybody else's.
They really know how to cut to your core.
Yeah, absolutely.
So Tyler and CMT, you guys are a treasure trove of stock market information, technical analysis. It's you guys are the bread and butter of the industry. To be expected from anyone that gets their MBA at IU, I saw.
Yeah. Yes, Indiana University. I happen to be a Hoosier.
Yeah, well, you happen to be on the bubble too, apparently.
That's right.
So maybe I'll get a prediction from you later. But let's start from the beginning. Walk me through CMT's role in the financial ecosystem and, what makes your services unique to a retail trader.
Absolutely. Thanks for having me on. And I have to start by saying that the CMT Association it's been the greatest opportunity of my life. I did get an MBA from the Kelley School of Business at Indiana University, and they gave me a very firm understanding of the accounting and corporate finance side, really driven by fundamentals. And that's an important part of the financial services industry. However, finance is not driven just by computers. It's driven by humans who have the tendency to be irrationally driven by their own fear and greed. That has been consistent for centuries, which makes the discipline of technical analysis an incredibly valuable tool. So after we left Indiana, got to New York City, I was looking at jobs in consumer packaged goods firms, and I thought for sure I'd be a brand manager for Procter & Gamble or something like that, as most Kelley grads end up. But instead, I found what was called the Market Technicians Association. We changed our name just a few years ago, but this is an association. It's a nonprofit credentialing body that's been a big part of Wall Street for about 50 years. And the reason it was started in the late 1960s is that Wall Street analysts would meet at the New York Society of Securities Analysts, and they'd break out after the luncheon, presentation into small groups. All the sector analysts from the automotive industry or healthcare or you name it would break off and have their own private meetings. And there were a couple of youngsters in their 20s that said, "Where's the room for the technical analysts?" And New York Society members said, "Oh, you guys, yeah, we don't have a room for you. We don't even understand what you do. And frankly, you probably shouldn't even be here."
Wow.
And I think financial news media has done a real disservice to all investors, whether you're institutional professional or you're a self-directed investor, to pit fundamentals against technicals, when in fact, they're two sides of the same coin. I mean, I want to understand the basics of the company that you're investing in, the new products that are coming out that are going to generate free cash flows that are going to change their balance sheet going forward. But when it comes time to make a buy or sell decision in your portfolio, you need to understand what the mood of the market is, what the sentiment readings are, and frankly, whether or not that price is trending in an up or downward direction. And that's what technical analysis tells you. It tells you what investors are interested in long before the fundamentals change. And so the CMT Association got started with those youngsters because they needed a place to showcase the professionalism of technicians and make sure there was a collegial group of people who would share ideas about what was working and what wasn't working. And I know it's hard for all of us in this generation to think about what life might have been like in a big firm like Merrill Lynch back in the 60s. But technical analysis was all done by hand. They had what they called war rooms. Their chart rooms in all of these major wirehouse firms had 10, 15, 25 people charting by hand every daily close of the market, calculating all of the indicators. So that heavy computation behind things as simple as like an RSI or a little oscillator. If they wanted to understand what was going on their chart, they had to compute it by hand, plot it by hand. But it gave them a real sense of what was happening day to day in the marketplace. And obviously, the CMT Association has stood for really two things. We help advance the discipline of technical analysis, which means all of the folks out there who are creating new tools, who are understanding new ways to implement them in portfolio management, are part of the organization and helping drive that research and the development of the tools. But also, we're a member services organization. So we want to help people improve their investment decision making and also improve their career prospects. And those are the two main drivers of our mission and what we do on behalf of members and charter holders all over the world.
Yeah, I see so much connective tissue between what you guys do and Schaeffer's expectational analysis, where you are combining the technical side with the sentiment side. And like you said, those two should be married. Those two should be working in conjunction with each other. So to see that thesis so obvious for you guys is very refreshing, because like you said, they're at war a lot. And I know at Schaeffer's, I just spoke with Katie before, we have three of our traders that are CMTs. With Bernie Schaeffer himself,
Yep.
I know Katie had recently won some Best of the Best award.
Yes.
I think before you guys had done the name change. So having worked with these people, I see their work. I see what you guys do on a day-to-day basis. So I guess to jump right in there, what are some analyses you think a retail trader should keep coming back to? What should be their wheelhouse, their go-to their go-to process, or is it more of tools that they use?
Really well phrased, Patrick. And I think you can separate them into two camps: tools versus process. So let's take them one at a time. If we were to pull up a chart of a stock and try to decide, you and me together, whether we should buy it or if it's already in our portfolio, we should sell it, we'd really want to know at least four things to get a comprehensive technical perspective on that trade. The first and foremost is the trend. Is it up or down? And you can do that just visually looking at a chart. Is it going from the bottom left to the top right, or the top left to the bottom right? That's one of the beauties of the human brain and our shortcuts, is that we are visual thinkers by nature. You can go back 10,000 years, and the human brain evolved to be able to distinguish between the spots and stripes that are on predatory animals, or if that's prey, right? Same thing exists for us at 10,000 years later. As investors, we can grasp a lot of information very quickly from visual tools. So trend. If you wanted to quantify something, instead of just looking at whether the line squiggles up and to the right or down to the right, you could use something like Donchian channels. You could use moving averages. There are a lot of tools, but I would strongly encourage everyone to start with the trend. 130 years ago, that was what Charles H. Dow started with, was that market's trend. They trend over multiple time periods. He defined three major time periods for the trend. But really, what we're trying to understand is how we can trade alongside the prevailing direction of the market. Now, I'm not here to dictate to any of the listeners how they ought to trade, what their strategy should be. That's really a personal decision based on their risk tolerance, the mechanics of what they're doing and what assets they trade. But you could be looking at intraday 5-minute charts, or you could be looking at weekly charts if you're, a big mutual fund manager, or you're a self-directed investor that just doesn't have the time to sit in front of the screen all day. Mm-hmm. You got to understand the trend first. The second thing that you want to understand, if you've identified an uptrend, you're going to look for confirmation or divergence from something called momentum. And the way Ralph Acampora explained this to me, he's one of the co-founders of our association. He said, picture a baseball in your hand. You throw that ball up in the air. The minute it leaves your hand, it's moving as fast as it will ever move. That's really fast momentum. And as it reaches the apex, the ball is going to head up into the sky, and then it's going to come back down into your baseball glove. It's going to decelerate. It's still moving higher, but it's moving higher slower as it reaches that top. And then it's going to come back down. Gravity will pull it back into your glove. So momentum, and there are a million different tools that people can use right on their charting platform. Let's just talk about RSI for a second, relative strength index. If you were looking for something like RSI in a lower panel underneath your price chart, you want to see momentum confirming an uptrend. So if you and I are trying to decide whether to buy this stock, we want to see that the trend is up and that momentum is positive, right? It was my first understanding that, if it hits overbought, then we're headed back down. And that's not the case either, right? A lot of these tools, a lot of the pitfalls for new users of the technical toolkit is that they don't quite understand what the indicator means. When it reaches overbought extremes, you know that there is very enthusiastic buying of this uptrend. You also know that it won't persist forever. So when that momentum dies off, that's the baseball hitting its apex, and it's going to come back down to your glove. That doesn't mean the trend is over, but it might consolidate, might digest some of those gains. You don't want to be buying as momentum is decelerating. Conversely, you could see divergences on the chart. So maybe price is making new highs, but momentum is not confirming with new highs. Maybe it's even gone into oversold territory, telling you that potentially the strength of that trend has really weakened, and we might even be looking for an area of reversal. The third thing that I would say for all investors is to understand volume. And it's another confirmatory indicator, right? We want to know if there is heavy volume confirming a trend, either in the upward or downward direction, right? If you look at, the end of bear markets, that capitulation, that final washout, it happens on very heavy volume. Everybody has taken so much pain as it's, traded down. The losses are accumulating in their account. Their P&L is destroyed for the year.
It's a mass exodus.
Yeah, mass exodus. And when they finally want to get out and you have that big washout, that's really where bottoming can start. Same thing if you're looking at topping patterns, that same trend with that heavy momentum and really heavy volume confirming. When it gets to the end of its run, you're going to see that volume dry up. And you're going to see that momentum start to wane and fade. And so those three are really critically important. If you've got the time and the interest, the fourth one, the last one that I would add in, is that you want to understand volatility as well. So things like Bollinger Bands or Keltner Bands have been really, really helpful to a lot of investors over the years, because as you understand contraction in volatility, you can start to add probabilities to your side. So a volatility contraction, right, where there's this tug of war between buyers and sellers, where it's not really decided which direction the trend's going to go. These tend to happen at periods of reversal or continuation. But you want to trade in the direction of that breakout. When we break a period of very low volatility, typically periods of low volatility will be followed by periods of high volatility in either direction. So those are the four: trend, momentum, volume, and volatility. The other side of the coin, right? That's how to do your analysis. The other side of the coin is how to be a consistent trader or investor. And that's the process. And we spend a ton of time throughout the CMT curriculum, in the CMT program, at all of our educational events and conferences, talking about process. And what we're really trying to dig at there are things like the expectancy formula, right? You can have a big loss, a small win, or a really big win, right? When you put a trade on, those are the only four outcomes. And the expectancy formula tells us that You do not have to be right all the time, but your winners have to outsize the losses of those small positions. You take the loss quickly and early. I know it's much easier to say than it is to do, and we could talk all day long about the human behaviors and the cognitive biases that keep us from being really disciplined investors. But if you have your checklist in your analysis, you use that toolkit, you understand that the trends in your favor, the probabilities are all on your side. Technical analysis also tells you very quickly when you're wrong, and you can close out of those small positions, take the small loss. And for trend following, right, which is where technical analysis has added tremendous value for institutions and individuals. For trend followers, they want to really lean into those bets that are working. The trade that is working in your favor, you want to stick with it. You want to be patient and hold on to that. And as Danny Kahneman or Amos Tversky and behavioral psychologists have taught us, we tend to want to lock in the win quickly, right? It went up 10%. I'm selling. I'm capturing those profits. Well, that first 10% may have led to another 100% move, and you don't want to miss out on that. So, using a disciplined process, something that's repeatable, that uses those toolkits and those rules to make the same decision every time, is going to allow you to have a good expectancy formula, so that your winners are outsizing your losers. And you might find that 40% of the time you're wrong, or 50% of the time you're wrong, maybe even more. There are some really great hedge funds out there that pick winning trades maybe 30% of the time, but they still make money over the long run because they have a very disciplined approach to how they manage risk.
Wow.
I know, it's like talking to a fire hydrant. Sorry about that.
No, I loved it. Well, what I loved about what you said about the tools is the similarities of, just from our strictly digital content, that's how we will break down a stock when we're writing it on our website. All four of those tools. But what I found interesting is when you got to the process, that's the options trading niche of controlling when you can leave and exit, the added time value, and you can introduce the Greeks and everything like that. And it draws me back to an example of one of our recent big trades that I wrote a post-mortem on was, a Facebook put with a 391% return. And that helped overshadow or accommodate for other losses. And I think that's so important for a retail trader to remember, is you're not going to walk in here and just start firing off wins left and right. It's more like baseball, where you have to look at a batting average and say, if you're batting, 300, you're doing great. Because, one of those hits accommodates for the rest. So I love the way you broke that down, versus tools versus process. Take that and apply it to, and I'll let you pick whatever, but apply that to like a current event situation. I mean, Russia, inflation, you can use whatever as to how an investor would dissect a development.
Yeah, absolutely. Those are two great examples. So something like geopolitical conflict. I would think about first looking at market history. And there's a great CMT charter holder who was at Schaeffer's for many years named Ryan Dietrich. He had a post just a couple of weeks ago. I think it was that Friday afternoon when conflict seemed imminent. Market sold off heavily on a late session on a Friday afternoon. I saw it on the chart before I saw the New York Times, dinging alerts on my phone. That markets react even faster than news agencies. Now, if you look at geopolitical conflict or any headline news story, and you look at market history, how has the market digested big headline news? You find that we tend to overreact to the headline, and the market digests quickly what's really going to play out. The Russian-Ukrainian conflict, I think, is maybe more interesting from the energy trade perspective, what that's done to supply issues around oil globally, or the potential threat to supply issues. I know there's new sanctions and cutting off some nat gas pipelines. Those kind of events, when you get below the broad index of equity markets, and you start looking at where that actually plays out in more specific commodities driven trades, there's a lot more to learn from that. But what I would say is that, having some perspective on what regime we are in, what the weight of the evidence tells us about the markets is much more important than any given headline news story. And I think we saw over and over and over again, at least Americans did, through our last presidential cycle, where the headlines about trade wars with China and we don't have to relive history, but there were constant streaming narratives of why the market should just be losing its shirt, right? And it didn't. And the S&P 500 just climbed as steadily as you could possibly imagine, and that's because the access to credit, low inflationary environment, full employment. I mean, there are a lot of macroeconomic factors that play a much heavier hand in driving overall market trend than any headline news story. So I would encourage all of the listeners, everybody who's reading Schaeffer's research, to be aware of what's going on in the world around them, particularly if you've got concentrated bets in things like oil. But I wouldn't trade my account based on news flow. Right? The news anchors are in the business of selling more views and clicks on their news stories. They're not there to help you run your portfolio. So there's that on the Russia side. On the inflation side, you talked about, thinking about your batting average. And I know for a lot of folks who got involved in the markets based on early trading successes in 2020, 2021 became a really difficult year. And the second year of a bull market tends to be really challenging. And maybe in 2020, anything you bought went straight up.
Okay, it's not just point and click anymore. I mean,
right?
You can't have sports website people who shall remain nameless, running live streams of, I think I'm going to buy this airline. Click, and I like this, and click. It was bizarre.
Throwing darts. We've all seen the TikTok traders in some far sandy beach somewhere, retiring, living the life, driving their new orange Lambo. That's not a repeatable, defined process. That's getting lucky, and we're not gamblers. We're investors, right? So with something like inflation, again, the narrative, the talk on financial news networks is not going to help you make sound decisions. But understanding regime change is really important. Right now, Fed funds rate, on a 10-year T-bill, it spiked up above 2% last week, but then settled down around 1.95. In December, that was as low as 1.4%. So we have stepped up quickly, significantly from where we were at, but quickly. But if, again, looking at the technical toolkit, if you look at a quarterly chart of interest rates going back to the 80s, we're still in that downtrend, right? Lower rates is the prevailing trend. And I think until we're above 2.5%, we really haven't seen a bottom put in for meaningfully higher rates. I also think, when I first bought a house in grad school, my grandma got on the phone with me, and God bless her. She said, "Tyler, as soon as possible, you need to pay off your mortgage. I just want you to know that it's really important that you try to get out from under that debt as fast as possible." This is 2005. I said, "Well, Grandma, I have a interest-free 5-year adjustable rate mortgage." I was a grad student. We didn't have any cash. Yeah. The bank said, "Yeah, go ahead and buy a house, and you just pay the interest, and after 5 years, we might reconfigure your mortgage." My point being, it wasn't an 18% interest rate on my mortgage, and so the regime that we are in, understanding where what that 30-year downtrend in the bond market has been, right? Bond prices move conversely to rates. So the bond prices have gone down as rates, bond prices have gone up as rates have gone lower. I don't think we're seeing the full effect of a big change there. I think there is inflation, and I think that that could play out in some, more hawkish behavior by our Fed governors. But again, that's not changing our day-to-day trading strategy. These are long-term secular movements. And so I think the technical toolkit, if you're looking at market history and you understand some of those intermarket relationships between the credit markets and the equity markets, you're gonna end up being much better risk manager and being able to capture those opportunities when they're there.
Mm-hmm. I remember I started here at Schaeffer's in 2017. I was not in finance. And I remember reading, writing, and processing these headlines all about the trade wars and leaving the Paris Climate Accords and all this. And I'd text my parents and be like, brace yourself.
Yeah.
This is, it's all coming. It's all going to shit here in a second. And turn up the next day and it's like, oh, up, 0.3%. That was a real-time lesson for me in saying that, the news headlines should be an arrow in your quiver, but not your entire thesis. And so, as pertaining to Russia, I recently wrote, a chart of the week on RSX and UNG, especially if, Nord Stream, but I ended it with the caveat of this isn't to say go buy them. This is just something to watch. And I think that's so important. And, today's investors, I think, are so easy for a quick soundbite and a quick little word that says, hey, go get this.
Yes.
Or go do this.
Yes.
That you need to go through a process. And it's so refreshing to see you guys do the due diligence and put in the actual work.
Well, and one other point to that is the concept of relative strength. So anybody listening to this, pull up your charting platform and just take one symbol divided by the other. Okay, so you want to look at the XLK, the technology sector ETF versus the S&P, right? For all of 2020, that was the trade, right? Off those COVID crash lows, the stay-at-home trade narrative, but technology, and in particular, mega cap names in the growth equity space carried the market higher. Tesla, Facebook, Amazon, Netflix, Google, you name it. Those were the stocks that drove the S&P 500 higher. And because it's a market cap weighted index, they make up a huge portion of the benchmark. Now, you get into 2021 and you saw rotation being spurred on by moves higher in interest rates. And you started to see cyclical sectors outperform growth equities, right? The value versus growth. This is not investment advice. And I'm not saying that, the next 10 years, it's going to be a value story and growth is over. But you can look at your charts and see in real time and react to changes in real time. And what we mean by relative strength is it's as simple as just trying to fish where the fish are, right? Growth equities outperformed value. We saw the tech sector leading the market higher. That's where you were going to find good opportunities for long. And quick point of clarification, right? RSI, the relative strength index, and I know technicians have not done a great job with our jargon or our nomenclature, but RSI being the momentum oscillator that you'd see on your chart, relative strength being the division of one security by another. So comparing, what is outperforming. Okay. And here in 2022, right, from January 1st, it's been energy. Financials have worked on and off, some cyclical sectors. We've even seen like staples and defensive names outperforming the index. That's where relative strength has rotated to this year. And rotation, as a concept, you'll if you talk to your financial advisor, they'll talk to you about, rotation strategies, tactical asset allocation models. There's a lot of names, smart beta, and some great fund managers out there who've really helped people take an active approach to rotating their funds to what is leading relative strength. The work of Dorsey Wright, Tom Dorsey's a good friend and a mentor. They've done a ton of work on relative strength. And so when you think about something like the inflation narrative, you want to turn to your technical toolkit and just see, has inflation impacted the markets in a meaningful way that makes new leadership, different sectors, different names start to trend both on an absolute basis, right? Their chart is going up and to the right, and on a relative basis, they are performing better than the index.
Interesting.
And in a really dark, bear market, most institutional money managers and traders are going to look at their relative performance. So if the index is down 30% and you only lost 10% for your clients, you're a hero, right? You avoided the massive drawdown by buying things that were going down less. That doesn't mean that you could find the perfect silver bullet, but you want to avoid the things that are dragging the market down fastest.
Yeah. Wow. You took me to school there. Thank you. You really did help me articulate that because I think I was poking around, but not really grasping it. And now I do. Yeah. So to pivot a little bit, I actually on the way into work listened to your Meb Faber episode.
Excellent.
I mean, that was fascinating. So I want to give the floor to you there and expand upon your own mentors and early influences. I know whenever I'm listening to a podcast and I'm looking to learn, I'm sitting there with a notebook. Whenever I hear people say names, I'm jotting them down. I'm jotting down a book. I'm sure I have listeners here who would love to see who has influenced your line of thinking.
Absolutely. There are so many incredible people who are part of the CMT Association. And like I said at the very start of this, this has been the greatest opportunity of my life. You get a job on the trading desk and you can call up all the portfolio managers, the big mutual fund companies or hedge funds, and they don't want to talk to you. They get 1,000 calls a day because somebody's always trying to sell them something. And what I found within the CMT Association is that if I picked up the phone and I called even the biggest money managers, they were happy to take my call, happy to talk about what was going on in the association. How could they, share back the industry that had helped them so much through their career? So when I first, got my feet wet in technical analysis over a decade ago, it was Ralph Acampora and Phil Roth, who were in the MTA office down on Wall and Broad, were right across from the stock exchange. And they would come in and do tutorials. And we still had some of the hand-drawn charts from Ralph's Prudential room in the MTA office. But also people like Gail Dudak, who's a great macroeconomist, Louise Yamada, who worked with the illustrious Alan Shaw. These women have been really instrumental in helping me understand how fundamentals and technicals can be combined. And then I got to thank people like John Bollinger, who is also a guest on Fill the Gap. Make sure to check out that interview.
Ooh,
I mean, he's got creative genius, and that's a word that gets thrown around way too much. But real intellectual curiosity, really wanting to know how does it work and get under the hood of each indicator, understand how it's calculated. He obviously the father of Bollinger Bands, the inventor of those volatility signals. But then, through my work with the board of directors, people like Bill Kelleher, David Keller, who was the managing director at Fidelity for many years and now the chief market strategist at stockcharts.com. These are people who really helped me understand how the industry works and how buy side and sell side relationships expand or contract. And Craig Johnson, Dave Lundgren, Larry Berman. I mean, there are a lot of mentors through the board of directors that have really helped kind of steer me in the right direction. And then I guess the other thing that I'd point out is the association is it's a great place to make friends. So people like JC Peretz and Robert Dombrower and Paul Siana and Katie Stockton and Alex Cole. They've been great just friends to study with, to learn with, to hang out with. And so I'm forever grateful to the CMT Association for that.
Yeah, if anyone's listening, I would rewind that and listen at 0.5 speed because you really need to take those names down, give them a follow on Twitter, plug them into Google, and learn what they have. I've been in this industry for 5 years, and every day I'm learning something new. And it's so much fun just to open up Twitter, and if you're following the right people, like you and everybody you mentioned, you learn so much just by scrolling through and just seeing everybody put their talent out there and their ideas. Yeah. It's a great way to disseminate information.
Yeah, Twitter didn't exist in the 1960s, but that the CMT members would have been sharing a lot of charts.
Right. Well, I mean, their version of sitting in their own little designated corner, that's Twitter now. So
that's Twitter now. Yeah.
Want to look to the future here. I know you had mentioned in our exchange of emails data visualization. And you said it's the technical analysis is evolving, and there's a lot of exciting developments on the horizon. Mm-hmm. I'm going to give you the floor again and just say, what do you guys got going on? What do you see as the future? Especially, we touched around it with the internet, and you start from computing the math on pen and paper to now. What's next?
So I read a book long ago called My Life as a Quant by Emmanuel Dermon. He's a professor at Columbia University and options pricing theory genius. But what he said is that when you do physics, you're playing against God, and you're playing against God's creatures when you're trading markets. And that line, in finance, you're playing against God's creatures, to me is just the Star Trekian, the horizon is always further out, in the sense that human beings and our human nature are always going to drive markets to irrational extremes. They're going to create opportunities for arbitrage and new discovery. And John Bollinger talks about first principles of the market, and that if there is something that is pervasive, that is resilient through lots of market cycles, it tends to come down to some observable trait about the markets and really about human behavior. So technical analysis, not to go back to TA 101, but this started hundreds and hundreds of years ago, mid 18th century, in the rice pits of Osaka, Japan. There's a guy named Monehisa Homa who understood that when it was festival season and the springtime weather was out and the cherry blossoms, traders would come into the rice pits exuberant, and they would overtrade, and that drove prices higher. And if they were, particularly despondent, depressed, maybe it was, seasonal effects or something else happening in the community, they would trade less, prices would come down. And what he discovered was that he could track prices and then trade in the highest probability direction of what he was seeing from the behavior of other traders. That is candlestick charting. So everybody who's ever pulled up a chart probably looks at candlesticks. And we have our old pal Monehisa Homa to thank for that.
That is unreal.
Right? It's unreal. The technical analysis is the oldest game in town, and it goes back to the mid 18th century. Now, the point I want to make is that by capturing price data and then putting it in a visual tool, you can see on a candle what the behavior of the traders in those rice pits back in the day, or any market now, what the behavior is that's driving price action. That's data visualization. That's taking a whole bunch of numbers, which, for the human brain, right, infinite decimals, it's all nonsense, but a picture makes sense. And so there's another great quant named Carson Dahlberg, also a CMT charter holder, and he does a lot of coding in Python, works with a ton of systematic strategy development. But what Carson really loves about technicals is that he could throw some code together in Python, but pop out a chart and instantly know whether it's given him the results that he wanted or not, right? From the picture, he can fail fast, to use the development term for software engineers, by just looking at the picture, because it's not the expected outcome. So there's a problem with the code. You can go back to the drawing board. Technical analysis and the new data streams that we've got coming at us, like, just think about the cryptocurrency space. You've got immediate visibility. It's anonymous, but you can immediately see exactly where every transaction is at. That's an incredible fertile garden for technicians to think about pulling those data sets into new visual tools. And then on the visual side, right, things like three-dimensional, if you're looking at volatility curves, or if you wanted to start thinking about your charts, bringing in other information, maybe it's a fundamental factor. Get that on your chart. You can get a lot of information much faster from a visual tool than you can from reading spreadsheet after spreadsheet. And throughout my MBA, and I feel very fortunate to have gone to a good school and had great professors. But man, pouring over 10Ks and 10Qs to understand and then estimate, right? There's tons of variables that you're just guessing at. You put that in your model and you guess at what fair value of a company is. That often has to be restated. It is just an estimate. It doesn't really help you trade. It helps you understand whether there's quality there of the company. And it's those underlying fundamentals that'll drive trends. But man, a visual tool, you can move a lot faster through a lot more securities and have a real comprehensive picture of what's going to work for you and your portfolio by using technical analysis.
Yeah, I was wondering if you were going to mention 3D and because just having looked at it myself and wondered, I think that's a way to invite a lot of people who might be a little spooked by a chart, but might see it from a different perspective that way. So it's incredible what the next 5 to 10 years could hold.
I guess I would say too that no time like the present has there been such interest in technical analysis and charting. Everybody with a brokerage account has access to really powerful tools now. Tools that were all done by hand when Ralph and Phil were, kids at Merrill Lynch and Smith Barney, and it was very labor intensive. And now we can carry around 5,000 charts in our pocket, flip through them with our thumb on our phone. The challenge there is that most new investors don't take the time to read a book or listen to a lecture or tune into a podcast to understand what those tools are telling them. Mm-hmm. All of those squiggly lines on your chart, not helping you unless you know what they're telling you. And I guess if there's any piece of advice I could give to any newbie in technical analysis, it's we all made the journey to try to find the silver bullet, and we've tested every possible indicator. The truth of the matter is, keep it simple. Find a couple things that work for you. Trend, momentum, volume, and volatility. That's all you need on your chart, and you got to keep it simple. Otherwise, all those squiggly lines are just going to create analysis paralysis, and you'll be able to convince yourself to hold on to a losing trade because there's enough squiggly line on your chart to tell you it's going to come back. But I think if you can simplify it and then make it repeatable, you have a much better chance of making money over the long run.
Yeah, very well said. And the best way to get that's the best way to avoid getting your wires crossed. Totally. Is keeping it simple. Well, I'm ready to wrap here. I mean, this has just been, information overload. I love it. So much actionable advice here. I can't wait to get this episode out. So, Tyler Wood, the Managing Director of Global Business Development of the CMT Association. You can check him out here. Let me plug. Let's see, cmtassociation.org is where you can find the website. And then, of course, check out on Spotify or wherever you get your podcasts, Fill the Gap, the official podcast of the CMT Association. Anything else you'd like to plug?
Yeah, if anybody has questions, I'm an open book. Hit me up at T-Bone Pickens. _T-Bone_Pickens on Twitter. Happy to make some new friends from the Schaeffer's community.
Yeah, I love that. I look forward to having you on again. One last question. I see the drum set in the background. Who are some of your favorite drummers?
I've been drumming since I was a very little kid. My dad was a drummer, and so we had a kit in the house even as a toddler. I've loved Carter Beauford. I've loved all of the great jazz drummers throughout history. But I gotta say, it's only since we moved up here that I've been able to play again. You live in a little studio apartment in Manhattan. Neighbors do not want you pounding on the drums,
especially New Yorkers.
Especially New Yorkers.
They really take offense to that.
Highlight of my life was going to see Roy Haynes at the Blue Note when we used to live down in the Village. And
that's the give and take of you can't play, but then you get to see all this amazing talent in the city. Talent. It's a give and take there.
Yeah, absolutely.
So again, Tyler Wood, thanks for coming on. Hopefully this is the first of many episodes.
Absolutely.
And this was incredibly illuminating. So,
cheers. Thank you, Patrick. So much fun. I'll see you again real soon. Say hi to Katie for me.
Will do.
Cheers.